Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello and welcome to Top Stock Picks here at Zacks. I'm Ben Rains. Today I'm breaking down Chegg, which trades under the ticker CHGG. The company allows students, particularly college students, to buy, rent, and sell textbooks online. Chegg's tagline used to be saving broke college students one textbook at a time. The firm still does boast that people can save up to 90% on textbooks, which is a solid niche market in an e-commerce age where Amazon does dominate online book sales. Today, however, Chegg is much more of a learning-focused company, or what it calls a direct-to-student learning platform. Chegg offers online tutors, test prep, and other help on everything from math to writing. Plus, it runs an online internship and job search platform, and its new essential pitch is, quote, a smarter way to student. So over the last several months, as most people know, schools around the US and the world have closed in an effort to slow the spread of the coronavirus. More importantly, digital learning was already becoming widely popular as college costs continue to soar. Shares of Chegg skyrocketed after their first quarter results, wowed Wall Street back on May 4th, and the company thinks that the coronavirus might have accelerated its growth for the long haul. So its CEO said that, quote, our belief is that in every industry, a crisis often accelerates the inevitable, and this is what we see happening in higher education. So looking back at their Q1 results, Chegg's first quarter revenue jumped 35%, with its services sales up 33% to account for about 76% of its total revenue. So that's that non-book sales. The firm also saw the number of Chegg services subscribers surge 33% to roughly 3 million. And it forecasts that the momentum it experienced at the end of the first quarter will carry over. So with this in mind, our Zacks estimates call for its second quarter sales to climb over 45%, with its full year sales expected to jump roughly 35%. And this would crush 2019's 28% expansion and 2018's 26% expansion. So some impressive top line growth this year on top of solid growth over the last several years. And then if we look ahead to 2021, we're expecting another 23% higher growth on top of this year's 35% growth. And then on the bottom line, we're calling for its adjusted second quarter earnings to surge about 48%. This would help its full year adjusted earnings climb 33% this year, and then another 22% in the next year. So with this in mind, the stock is up 50% in 2020, which is certainly no easy feat, and over 350% in the last 3 years. Yet, despite this run, the stock sits about $10 off its recent 52-week highs at $57 per share, which might mean that it's already experienced its post-earnings pullback, which might set up a better buying opportunity. And Chegg's earnings revision outlook has certainly improved since it reported its earnings results, which helps it earn a Zacks ranked number one strong buy at the moment. And it also rests within an industry that sits in the top 12% of our more than 250 Zacks industries. And longer-term investors certainly might want to consider Chegg as a bet on the future of education becoming more digitally focused, especially as costs and student debt continue to grow out of control. So that does it for me, Ben Rains. Now we're going to turn it over to Brian Bolin.
Thank you, Ben, for throwing it over to me. This is Brian Bolin. As you may know already, I'm the aggressive growth stock strategist, and for my top pick, I've got Dynatrace, and the ticker here is DT. DT for Dynatrace. It's a Zacks rank number 2, and that's a buy. And it has a great growth divergence that, I love to see from my aggressive growth stock videos, with a solid growth score of B and a weaker value score of D. And let's just take a quick look at this one. And, I love to start with the beats. The stock has beat every time here over the last year. And these are big beats. 46% is the average positive earnings surprise. And we can see estimates are moving up here. In this day and age, things are going to start to turn the corner here pretty soon. But this one has already kind of turned the corner. We've already seen estimates move up. A lot of names have seen negative earnings estimate revisions, and everyone was worried about the COVID and what's going to happen. So positive earnings estimates already here. This does have a very difficult pill to swallow here called the valuation. 91 times forward earnings. That's a gigantic multiple. 10 times book is a little bit rich, given everything here, and 18 times sales also a little bit rich. But the thing is, our earnings estimates are moving up, and there's excellent growth, 30% still on the top line. The growth story didn't come off, in the middle of the pandemic here for this one. Um, this is ugly to look at here, but these margins here down the bottom, the net margin it's moving in the right direction, and when you see that, that means we're going to head towards profitability, and everything's going to be okay. So let's take a quick look at the chart here, and we can see this. This stock wasn't, I don't want to call it without sin, right? There was a big movement here lower, but it has snapped back, and we're already above pre-crash highs, and the stock continues to do well. As we film this video today, it's June 9th. We can see the stock is up. It's up strong, and the market right now was weaker this morning, but this stock is up strong again. This is a name that I really like, and I think it's a good one. Definitely to keep on your radar screen. It's Dynatrace. Its symbol is DT.